everyone, welcome to our presentation. In this video, we are going to talk about why the financial industry is moving away from LIBOR. LIBOR has become less dependable and reputable since the financial crisis in 2008. First, LIBOR has an inherent weakness that makes it potentially manipulatable, considering there may be little or no real borrowings by the bank at different tenors that are quoted on any given day. In this situation, pooled banks had considerable leeway over the interest rates they reported, providing their best estimate of what their borrowing cost would be if they wanted to borrow. Second, LIBOR is based on panel bank input, which includes credit risk, and LIBOR reflected the unsecured money market and no collateral required. There's a potential risk that bank counterparty failing to meet its obligations in accordance with agreed terms. If a high level of credit risk perceived, lenders and investors will charge higher interest rate. Third, LIBOR calculation is based on the average daily estimates of the transactions for the various maturities borrowing rates, and the market size of LIBOR is relatively small. Therefore, LIBOR will be less accurate. Given the shortcomings of LIBOR, market participants are actively encouraging to switch from LIBOR to other alternative benchmarks.
Considering this weakness of LIBOR rate, the needs for a replacement reference rate are precise. One of the possible rates is secured overnight financing rate. The key characteristic of LIBOR rate is it mainly based on estimate. However, the SOFR rate is based on actual transaction in the repo market, which is one of most transparent and active market in the world. Also, SOFR rate is secured by American Treasury bonds and is considered to be free of liquidity risk. Compared to the SOFR rate, the LIBOR rate is an unsecured rate and thus includes the liquidity risk premium. Also, the financial market from which SOFR rate is derived involve a wide range of the market participants that give SOFR rate a board of representation of the financial sector.
Multinational companies need to adopt strategies to deal with the risk of interest rate fluctuations, because interest rate fluctuations may have a significant impact on their financial situation. Specifically, the following are the strategies. For internal strategies, first is to expanding their business to many countries and regions to spread the exchange rate risk in order to better cope with interest rate risk. Second is to adopting appropriate strategies to reduce the impact of the new exchange rate indicators on the company in order to better develop its international business. Third is establishing an effective risk management system, such as formulating interest rate risk management policy. For external strategies, first is to establishing cooperative relations with local enterprises, which can help them reduce their sensitivity to exchange rate fluctuations. Second is to re-evaluating whether risk management strategies and business decisions are suitable for the current development environment to adapt to the new exchange rate indicators. Third is strengthen strategic cooperation to reduce the impact of new exchange rate indicators on companies. Multinational companies need to adopt strategies to deal with the risk of interest rate fluctuations to ensure the stability and sustainability of their financial situation.
Since SOFR also has limitations, some new issues arise when SOFR is used instead of LIBOR. For example, compared to LIBOR, SOFR is not sensitive to credit risk. This is because LIBOR is an unsecured lending rate, and the interest rate includes the bank's own credit risk. SOFR is a secured pledged repo rate that only reflects interest rate risk, and the SOFR rate does not cover the bank's own credit risk. If faced with systemic financial risk, banks may be exposed to a large risk exposure. To address this issue, I believe that two benchmark interest rate indicators can be used simultaneously. On the one hand, using SOFR as a risk-free benchmark interest rate. On the other hand, also constructing a new interest rate indicator that can measure banks' credit risk in order to make it more widely accepted by banks.